Good day. Please like the video, subscribe to the channel, and comment as you see fit. Today we're going to talk about a Wall Street Journal article in the business section. Fed's easy money pumps up winners like Apple and housing. Let's go to the article.
Fed's easy money pumps up winners like Apple and housing. Apple stock and lumber futures are soaring thanks to the Fed's largesse. The rest of the economy will have to wait. By August 27, 2020, 11:18 a.m. ET, Jerome Powell, chairman of the U.S. Federal Reserve, at the Jackson Hole Economic Symposium on Thursday. Photo. Daniel Acker. Bloomberg News. Winning investments this year include technology stocks, gold and, lumber. Yes, lumber. Pieces of wood may not be as glitzy as Apple AAPL minus 0.16% or bullion. But like them, lumber and other assets linked to home construction have been big beneficiaries of the Federal Reserve. Helping home building is one obvious way to help the economy. Helping Apple shareholders, not so much yet. Even the Fed's contribution to soaring tech stocks should trickle through eventually, in a convoluted way. That's lucky, because the Fed's new way of thinking laid out by Chairman Jerome Powell on Thursday suggests easy money is here for the long run. High tech, no tech low rates have boosted housing and lumber futures as well as big tech stocks. Change this year's source. Refinitiv * S&P 500 home building sector. %CME lumber Amazon Apple Facebook A home building * January 2020 August. -50 -25 0 25 50 75 100. The link from low rates to housing is obvious. Easy money from the Fed dragged the standard 30-year mortgage rate below 3% last month for the first time. Low rates are pushing up house prices despite recession and unemployment, in turn encouraging home building and helping the stocks of house builders soar. Add in lockdown home improvement projects, renewed trade frictions with Canada and low inventories, and it is understandable that lumber prices have more than doubled, and far outpaced shares even of big winners Amazon, Apple, Facebook, Alphabet and Microsoft this year. Stocks of home builders such as D.R. Horton, Incorporated and Lennar Corporation are in the tech pack, too, although not so startling as lumber. Market divergence. Growth of 6-month return on U.S. growth stocks minus value stocks * source. Professor Kenneth R. French * growth stocks defined as highest 30% by price-to-book ratio, value lowest 30%. Percentage points recession 70 19 30 40 50 60 80 90 2010 20 minus 150 minus 125 minus 100 minus 75 minus 50 minus 25 0 25 50. The great plus is that these prices suggest at least part of the economy is healing. The Fed is offering cheap money, and home buyers are taking it. Weekly applications for mortgages to buy a home reached the highest this summer since Lehman Brothers collapsed in 2008, according to the Mortgage Bankers Associations of America. It's come down a bit since then, but year-over-year growth of more than 27% in mortgages for purchases is extraordinary with unemployment above 10%. The trouble is that it takes time for this help to filter out to the rest of the economy, at a time when the country's recovery is deeply unbalanced. Those without jobs who have had their unemployment benefits cut thanks to Washington gridlock will take little comfort from the fact that work-from-homers can afford to buy a bigger place with an office. A similar division is underway in business. Credit-worthy companies able to issue bonds have access to super cheap money. Those with ratings deep into junk territory are having to pay more than before the crisis, while those reliant on banks are finding that lending standards are tightening faster than they did in the 2008-09 recession. Pandemic? Recession? Get a mortgage. Applications for loans to buy a new home hit a post-2008 high this summer. Index of mortgage applications for purchase source. Refinitiv note. Weekly data, not seasonally adjusted. Recession 2007 10 15 20 0 50 100 150 200 250 300 350 400 450 500 550. Consider Apple. Helping a $2 trillion company issue low-rate bonds to buy back its shares is hardly a national priority, but is one of the side effects of Fed action. It isn't only a side effect, though. The benefit should, in a roundabout way, eventually end up helping the real economy. Since the pandemic began, Apple has raised billions of dollars in bonds at low rates, most recently paying 1.25% on 10-year debt, in part to finance buybacks. It can raise the money more cheaply thanks both to the Fed's rate cuts and Fed's support of the corporate bond market, boosting Apple's profits and allowing it to do more buybacks, assuming Apple's expansion plans are already fully financed. No easy money from banks. Banks tightening lending standards * source. Federal Reserve via St. Louis Fed * net percentage of domestic bank tightening standards on commercial and industrial loans. Percent recession large and mid-sized firms small firms 1991 95 2005 10 15 20 minus 40 minus 30 minus 20 minus 10 0 10 20 30 40 50 60 70 80 90. The buybacks put some of that money into the hands of an Apple shareholder, who might invest it elsewhere, save it or spend it. Money spent is simple, helping the economy. Money saved in a bank is simple too, hindering growth. If the money is reinvested, it's more complex. It goes into the pocket of the seller of the shares, who then faces the same choice. If everyone keeps reinvesting, prices get pushed up until eventually someone decides to spend the money, or a company decides to issue stock. That, in turn, could be to finance a new project or recapitalize a struggling business, or, more likely, to allow investors in a private company to get out via an IPO, then starting the process all over again as they are left with cash and the choice to spend or reinvest. Share your thoughts. What do you make of the Fed's efforts to restart the economy? Join the conversation below. Investor preferences get in the way of this process because investors want to buy the winners. So the Fed's easy money pumps up the stock prices of the winners, but does little for the companies that investors can see are suffering, such as airlines, clothing stores, and anything connected to tourism. Capitalism requires winners and losers, but the stock market's divisions are huge. The performance of cheap and expensive stocks has widened more this year than ever before. In large part that reflects the coronavirus reality, as revenue collapses for entire sectors while a shift online boosts the winners. But the division is accentuated by easy money. Housing, home builders and lumber have joined the pandemic winners thanks to Fed policy. The rest of the economy will have to wait. Related video. Apple hits $2 trillion market value as App Store battles continue 000 130 023. Apple hits $2 trillion market value as App Store battles continue. Apple is now the first U.S. company to hit a $2 trillion valuation. But the milestone comes as its key App Store business model comes under attack. WSJ heard on the streets. Dan Gallagher explains. Photo. Bujwal Chukrod SOP Images. Light Rocket via Getty Images. Originally published August 19, 2020. Write to James McIntosh at james.mcintosh@wsj.com.
So there you go. The Fed is, doing their job and stimulating the economy, but in that stimulation, they're affecting a couple companies. What do you think? Let me know. And wouldn't you like the Fed's money invested in your company?